After the US Federal Reserve surprised the market with a larger than expected 50 basis point rate cut in September, all eyes are now on the Reserve Bank of India set to announce its monetary policy decision on October 9th. But despite the global trend of rate cuts, experts predict that RBI may hold off, keeping interest rates steady at 6.5%. Well, why is that? Several domestic factors point to a cautious approach even as the central bank faces growing pressures from a slowing economy. For instance, India's economic growth has been losing steam. The first quarter growth rate for financial year 2025 came in at just 6.7%, below the RBI's projection of 7%. Since then, key indicators such as vehicle sales, cement volumes, fuel consumption, and even GST collections have all shown sluggish growth. Even government spending, which typically boosts economic activity, has remained subdued in recent months. Adding to the mix, exports, which had shown signs of recovery earlier this year, have started to falter again. According to analysts at Nuvama, the economy may be returning to pre-pandemic levels of weak demand, with capital expenditure to GDP ratios plateauing. This paints a picture of an economy grappling with slowing momentum. On the inflation front, while headline inflation still remains above RBI's target, core inflation excluding volatile food prices as well as fuel prices have been declining steadily for the past 16 months. It's currently hovering between 3.1% and 3.3%, signaling weak consumer demand and muted growth in consumption-driven sectors. Here's where things get tricky. The RBI faces a delicate balancing act. While inflationary pressures are easing, slowing domestic demand and weak exports suggest that the central bank might need to reconsider its current stance. Add to that the fact that government tax revenue growth has slowed to single digits, further limiting the scope of increased government spending in the quarters ahead. Globally, the rate cut cycle is also underway. The European Central Bank, the Bank of Canada, and even the US Federal Reserve have slashed rates to combat slowing growth. But India's circumstances are more complex. The RBI may not want to rush into a rate cut cycle just yet, given the mixed signals coming from inflation and economic growth. That said, many expect the RBI to tweak its stance. Instead of continuing with a withdrawal of accommodation policy, the central bank might see it fit to shift to a neutral stance, essentially signaling that it's open to rate cuts in the future, but only once the economic picture becomes clearer. The real turning point could come in December of this year. By then, the RBI will have more data on the second quarter's GDP performance and the impact of the ongoing harvest season, which could ease inflation further. This would give the central bank a better view of whether rate cuts are necessary. For now, it seems like the RBI will need to keep rates unchanged at the upcoming meeting, but a shift in tone could lay the groundwork for future rate cuts if economic conditions deteriorate further.